So they're building silicon photonics-based optical chiplets, whatever that means. For short, IOTC. I'll be honest, I didn't dig into it to a sufficient degree to be able to explain that.
Hi, everyone, and welcome to a new episode of the VC React podcast. Every week, we bring you insights and reactions from top VCs, LPs, and angel investors reacting to the latest news on startups, VCs, and investment rounds. Let's jump into it with our amazing guests for today. Amleh, founder and managing partner at Ibtikar Fund. Arnav Danthi, principal at Nuwa Capital. Fahed Qteishat, associate director at MEVP. And as always, my co-host, Jamie Lane from FWDstart. In the video description, you can find more details on our guests, their LinkedIn profiles, and links to their companies' websites. Our weekly news are brought to you by FWDstart, a twice-weekly newsletter that breaks down what's happening in the MENA startup, VC, and tech space. Before we start talking about the news of the week, I want to tell you about OCTA, our new sponsor. OCTA is an AI-powered workflow automation platform that helps modern businesses collect payments faster, smarter, and without the back and forth. If you're a founder or a finance leader, you know that managing receivables requires 14 hours plus every single week. It's chasing corrections, negotiating payment terms, updating invoice details, and constantly following up with your clients.
OCTA automates the entire process, handling everything from invoice disputes to payment confirmations, so your team can focus on growth, not admin work. That's why more than 100 companies like Careem, Lean Technologies, and Algram trust OCTA to streamline accounts receivable. Check out OCTA at weareocta.com. That's WEAREOCTA.com and experience the modern way to manage receivibles.
Hi, Jamie. Welcome back from your vacation.
Thank you very much.
Welcome back, everyone, from the Eid holidays. What's happening this week, Jamie?
Yeah, so look, we're seeing more consolidation on the B2B marketplace side of things. Obviously, earlier this year, or was it last year? I'm losing track of time. We had Wasoko and Maxab, obviously merged in North Africa and Kenya. It was last year, was it? Oh, God, okay. Losing track of time here. But look, this time around, we have Saudi's Sari and Bangladesh's ShopUp. So two of the largest B2B e-commerce platforms in their respective markets have teamed up to create a new entity called Silk Group. Very clever play on the Silk Road there, but with a Q. They're describing it as the largest B2B commerce platform serving the Gulf and emerging Asia. And they've also backed it up with a pretty hefty 110 million in funding as well. Now, that's a mix of equity and financing. The exact breakdown hasn't been disclosed in terms of who's backing that. Then you have, it was led by Sanibel Investments, wholly owned by the Public Investment Fund, and then you have Valor Ventures as well, the US-based firm co-founded by the notorious Peter Thiel. Other backers, Qatar Development Bank, and there's a long list of existing investors in there as well. In terms of previous funding, they've both raised a ton. Interestingly, both back in 2021, those lofty, frothy days, when they both raised $110 million each, respectively. Together, they've onboarded, I think, something like 600,000 retailers, restaurants, hotels, cafes, and the like. And there's over 5 billion in transaction volume across their platforms as well. Interestingly, as well, they do highlight the fact that it's not just exclusively, I suppose, a commerce play anymore either as well. They've also introduced a financial services arm, Silk Financial, that seems like it's going to be a pretty prominent part of the strategy moving forward as well. I think they've collectively dispersed something like 750 million already in financing. I suppose it's an interesting one. And I'm interested to get your thoughts as well, Arnav, because I know Nuwa have thoughts on B2B marketplaces. So you have a thesis as far as that's concerned.
Historically, at Nuwa, we've decided to stay out of the B2B marketplace game. Although it's a large market and a large TAM, we've always thought, given it's super capital intensive and their low gross margins, it's not a space we wanted to touch, especially with some of the valuation multiples some of the B2B marketplaces were raising at, I think you mentioned in 2020, 2021. So it's not something we've invested in before, and that's by design. That being said, though, it's really good to see consolidation in the space. I think that's only going to help everyone. If you share the resources on the back end, you have a leaner cost base, you can get your margins up, right? The second thing I think I want to just touch on, I think ShopUp in Bangladesh has done a really good job of embedding financing and lending into the platform, where I think, sorry, if I'm not mistaken here, has mostly focused on the core business. So I think the combined entity is going to be good for Sari as well, because it can really expand their margins and their stickiness from the B2B financing side, which is, I think, where you make most of the margins in B2B e-commerce. So I think it makes sense to go that direction. I also think the market is quite interesting, the kind of combination. We speak a lot about, I would say, the US, India, China, Southeast Asia. We're now seeing like the GCC, Southeast Asia, and we've been seeing what's happening in the markets over the last kind of 2 weeks with all this trade stuff and the trade tariffs. So I think we're going to see a lot more interesting combinations of trade corridors, I think, come up. So I think it's a good decision all around for all parties.
Yeah, Amber, what do you think? Does this put pressure on other B2B marketplaces in the region to merge or maybe die? Or is there still room for the small independent ones to thrive?
Look, I agree with Arnav that the consolidation is good. I think that there's a lot of competition in the space, a lot of sort of new entrants trying small different angles. And so I think consolidation is better, especially in a fragmented marketplace as B2B. I think that, each country has idiosyncrasies, but can be completely, you can learn from one another and you can totally do it at the same time. And I think I love the Bangladesh angle. I think, as Arnav was saying, it's time to really think about different trading partners and different avenues for growth. I think a Saudi company understanding the Southeast Asia marketplace will only strengthen the MENA region, and likewise the other way around. I think it's important to just start looking in other directions. So we have a B2B marketplace. I would love to see some consolidation and more consolidation in this space. And the fintech angle is also great. I really agree with that.
Fahed?
Yeah, I would like to highlight, on top of what's being said, and why this is a big deal for the region or Saudi Arabia specifically, and to us as well. This is the first major, let's say, South Asia B2B MENA merger that combines logistics, embedded finance, and has a good footprint already across 2 regions. So there's a clear value here of this merger on the geography itself. It shows cross-regional synergy, basically. It combines Sari's Gulf logistics and fintech rails, basically, with ShopUp's deep penetration into South Asia. This is a dual brand strategy that obviously shows local trust. This leverages global operations efficiently, and this paves a way not just for locals within the region. This shows also some leeway for other regional and international players to get into the region. So this shows a lot of potential there as well. Since they're considering to IPO in 2027, as they mentioned, this obviously aligns with how Saudi Arabia is building towards having the vision in 2030. And as I said, this could pave many ways and create this ripple effect for businesses that could benefit from this as well.
This looks like a merger in preparation for an IPO, like you mentioned, Fahed. So why merge instead of acquiring, or one acquiring the other? Especially when both companies essentially do the same thing. It's just in 2 different markets that both companies kind of raise the same amount of money. Why do you think they decided to keep both brands or brand names instead of unifying in the one brand? Does that help or hurt on the long term for the IPO story? What do you think?
Look, I think the markets are differentiated enough, and they've both built enough brand equity that there is an argument for sure to be made for keeping both brands alive. I think they probably are exploring where they're going to IPO. So, where is this going to grow stronger? And just making some assumptions here, but as Arnav mentioned, there's likely very important synergies. I think that ShopUp is probably doing things very, very well in some spaces, and Saudi as well, Saudi has the cash, right? Certainly much more than Bangladesh does. So I think there's a lot of synergies here that remain to be explored, and it doesn't seem like either of them really had the cash to acquire the other. So that's probably another reason. Yeah.
Makes sense. Arnav, what do you think?
I think Ambar covered a lot of the nuances with each company. I think the only takeaway I'd have is when you have, let's call it, themes or types of companies that have raised a significant amount of capital, maybe at valuations that are a little bit above, let's call it, the market in in, let's say, good times, I think combining two entities is harder than it looks. There's a lot of investors on both sides of the table. There's a lot of opinions on both sides of the table of what each entity is worth. So I don't think anyone wants to throw in the towel and say, we want to get acquired. So I think there's also a little bit of that going on. So I think it just makes more sense to consolidate and get the pros from each kind of business to merge it into one entity versus one completely take over the other, just to keep the investors happy as well and all parties kind of aligned. I think these types of deals, when you have so many investors on board, and we can see also the number of investors that are investing in this combined entity, that's a lot of mouths to feed. That's a lot of people to keep happy. So I think it's just simpler.
I would also add to that it's a stronger strategy, much more efficient strategy if they're considering to list in the Saudi stock market. Doing a consolidation makes sense rather than doing an acquisition and starting from scratch. This gives them a much more propelled growth towards that IPO.
Yeah, and it seems to me, correct me if I'm wrong, Jamie, they focused a lot on Silk as a financial services company more than a B2B marketplace. So maybe they're taking the finance part or the financial services part into Silk itself, the mother company or the group, and then the other companies will be taking that financing from Silk and focus on the B2B marketplace. But hey, we talked about the IPO, and we mentioned that there are a lot of big names in here, like Sanabel, Peter Thiel's, Valar Ventures, and many others backing this deal. A win here could really boost global investor confidence in the region. And I hope they do the IPO in Saudi. I think they mentioned that. But let's flip it. What could go wrong? And what should they be careful to avoid if they want to make this a true success story, true IPO, like a global IPO in Saudi? What could go wrong?
It's a great question, I think, just generally. Just thinking out loud, the B2B marketplaces have a lot of cost of goods sold when it comes to logistics, when it comes to a lot of these costs that push a transaction through. My only question would be how much can really be merged on the back end side to boost margins if each country has its own nuances. And because this is B2B marketplaces that have these kind of large AOVs, you need things to be a little bit more on the ground and local. So, and the two geographies are kind of far away from each other. So my only question is how much integration could really happen and what are the key cost savings here? The big kind of cost saving I see is that if you combine both entities and then you're also doing embedded lending, if you start raising capital at the holdco level and you have a bigger base, it's easy. It's a cost of funding comes down dramatically as you have a bigger balance sheet, right? So that's a key saving. But when it comes to the core business, a question of how much you could really optimize, I would say that's a big question from my end.
As we were talking in the last question, I was thinking about just the management of this, right? Like who's going to call the shots? And even, as Arnav was saying, as you're discussing us at the board level, et cetera, like there's a lot that could go wrong. It's not easy to merge two very different cultures and two very different, even just the way that companies operate, right? So the culture within the company and the culture in each geography. So, but I hope that, as in the lead up of all of these of the merger itself, all of these discussions should have come up. So I hope it's been cleared and there's sort of a clear path going forward. But yeah, I think it's not easy. It's not easy when a company acquires another and there's a clear sort of boss. And so in this case, I think it's a bit even more complicated.
Just on the leadership question as well, to interject, it's going to be, in terms of the overall Silk Group, I think it's going to be ShopUp's founder, Afif Zaman, is going to take over the reins there as the CEO. And then I think it's Sari's founder, Mohammed, he's going to take the reins at Silk Financial. So I think that's sort of the arrangement that they've come up with. And yeah, it's going to continue operating obviously under both brands in their respective region. And it's the infrastructure play on the back end with regards to the integration.
And very interestingly, the big investors invested in ShopUp. And then by doing this merger, the Saudi company kind of brought those big international investors to the region. So I think it was a very smart move. Okay, we have a lot
hopefully
going on today.
Hopefully this also means attracting more of those investors to our region, right?
Yes,
so,
yes,
yeah,
hopefully.
Could go.
One thing I would add here, Ahmad, it's exciting to see Saudi and Qatari investors on the same cap table. Believing in companies expanding to the region. This shows how much confidence this could be disruptive. And I believe, as Ambar said, there will be a lot of challenges, especially on the operational level. getting the ball rolling would be the biggest challenge I see in the first place, just to start working properly as a company, especially after merging two teams or however they want to do it. I think and getting to the most optimal, efficient point will take some time. However, I think these guys know what they're doing, and that's why it makes sense to have a local partner when you have a merger.
Yeah, and it seems they're giving themselves 2.5 years until the IPO. I think they can do miracles during that time. Well, we have a lot to cover today. Jamie, what's next for us?
Yeah, let's turn the attention to semiconductors and Egypt then. This is a super interesting story. So it's InfiniLink, the Cairo-based semiconductor startup. They've raised a sizable $10 million seed round, develop next generation of optical connectivity chips for AI data centers. So in terms of the round itself, was led by MediaTek. It's a Taiwanese semiconductor giant, publicly listed company. I think the market cap is currently about $70 billion. And this was alongside as well Sukna Ventures, obviously the Saudi-based VC firm, Egypt Ventures, and there's angels from the US, Europe, MENA, etc. Startup itself was founded back in 2022 by Ahmad Abul Ella and Batras George, both seasoned chip engineers themselves. They previously worked on establishing MediaTek within Egypt. And I suppose the sort of company's core insight is relatively simple, that AI models are scaling rapidly, but data centers can't actually move the data fast enough between processors, using, I suppose, traditional kind of copper and traditional optical setups. So they're building silicon photonics-based optical chiplets, whatever that means. For short, IOTC. I'll be honest, I didn't dig into it to a sufficient degree to be able to explain that, either to myself or to all of you. So I'll skip over the technical details if that's all right. In terms of the company itself, the R&D is based in Cairo. And look, I think the MediaTek backing is obviously crucially important, both technically and commercially. I think that helps a lot. The funding is going to help in terms of team expansion. Having been on their LinkedIn page, they're hiring for a variety of different roles. So they're really ramping that up. And look, it's part of a broader sort of trend, I suppose, worth watching with in Egypt's sort of nascent semiconductor space. Pearl Semiconductor last year raised 4.5 million from Swari Ventures and Sharuk. So it's an interesting one. So look, InfiniLink could be, maybe MENA's first globally competitive chip startup. We'll have to watch this space.
Does anyone want to explain the technical innovation behind InfiniLink?
I can start with what I briefly know about the space. What they're creating basically is replacing or augmenting traditional copper connections in AI data centers. What they're building is something that's faster, has a large bandwidth, lower latency, higher energy efficiency compared to what AI data centers are using today. So it's super exciting. I really have to jump why this excites me, because this is deep tech coming out of our region, out of Egypt, and this isn't another, like a SaaS or a fintech round. This is true semiconductor innovation from Cairo. It's a rare move that positions MENA in the AI infrastructure value chain, especially with what's happening right now. So we're not being just a user and we're building businesses on top of it. This is a core AI business that can help disrupt the AI industry globally. So being backed by a global giant like MediaTek is a huge validation to these guys. So it's not just capital, it's a go-to-market, it's R&D, it's supply chain support. This could really accelerate commercial partnerships, global distribution, and having a good footprint. Imagine the types of businesses that can build on top of that within the region as well. I understand that talent is booming in Cairo. However, this pushes the whole market to the next level. So it is exciting.
And Fahed, let me stay with you then. Given how fast AI workloads are exploding, what challenges do you think InfiniLink might face in scaling their chip tech to keep up with global data centers demand? And just last month, we talked about how some startups raise money and start scaling only to find that their tech is already outdated. The acceleration of technology in the AI era is huge. So maybe that's in software, but does that happen in hardware too? Or is it a different life cycle?
I think it's a matter of time. There are many other players that we heard of that has been trying to build the same model of being more efficient in terms of AI hardware. If you take GCC, for example, يعني GCC and Egypt both have been trying to focus on the same model. In the Gulf, specifically in Saudi and UAE, they have been backing R&D related to chip technology and AI. However, nothing has materialized yet. We've seen a few of those in R&Ds. We've seen some in Qatar as well. They're less visible, but they've been funding AI infrastructure and advanced electronics through their universities and R&D centers. So I think it's a matter of time. It's يعني who gets to it first. However, I truly believe it's much more interesting, and the outcome because of talent can be Egypt first when it comes to these semiconductors and AI chips.
One, I think it's great. I completely agree with Fahed and Jamie. Inshallah, this is the beginning of something bigger, but there's a lot to overcome. Chip production and manufacturing is incredibly capital intensive. It requires a ton of stability in terms of geopolitics and just the ability to get these chips in and out, to get really, really expensive equipment into the country. And so there's a lot of very heavy global competition, right? We're not talking about, sort of other emerging markets. We're talking about Taiwan, Korea, the US, less so the US, more into chip design, so I would love nothing more than to see that an industry like that bloom from Egypt. I think it'll require strong partnerships with the universities that Fahed was mentioning in Qatar and Saudi, like really sort of as a region to have a strategy and say, we're going to do this. I love the diaspora angle here. I think the fact that these two men came back to Egypt and said, we're going to build this in Egypt because we see the talent, we see the opportunity, that they brought this Taiwanese company, it's Taiwanese, right? I think, Jamie, in the article you mentioned that the company has already been involved in helping them get set up, et cetera, and now is putting in this money. So I wanted to succeed. I really wish them all the best. And I would love to see this replicated, right? Or we focus on Egypt, this is where it's going to be made, and Egypt is open to bringing in that talent from the region and that support from everyone. So I hope for the best here.
Yeah, maybe for mine, I just want to echo that. I think taking a step back, I think in the last quarter or even a little bit longer, it's great to see the quality of talent coming to the region, especially moving into the GCC, whether that be from diaspora, whether that be from the UK, the US, Europe. I think at Nuwa, we've been seeing such a great, amazing talent move here, which we've never had the opportunity to back before just because of regional mandates. So for us in the VC, it really unlocks a whole new pool of founders that we could back and a level of founders that we've not seen before. So I think that's really, really interesting. And also a lot of the talent now we're seeing an uptick in technical talent, which really wasn't the case before, which I think is only going to unlock another set of amazing companies. Historically, it's been, commercial founders or operating experience, some that have operating experience, but we're seeing this new wave of technical talent move here as well, and top technical talent, which has always been missing from the region. So that's kind of my takeaway. I think they've done a great job in getting a strategic on board. I think if you want to have such an ambitious plan in this region, you need the government on board, a strategic on board, and investors on board. And I think they've hit 2 out of the 3, if I'm not mistaken, from the announcement. So at least they're making the right steps or the right movements to get there. And I think it would be a great story if it turns out to be a success.
Yeah, one thing I would add, if you allow me.
Please.
So VCs in the region has been shying away from investing in hardware, as we know. As Ambar said, it's capital intensive, it's expensive, it requires a lot of R&D budget. Time to go to market is a bit lengthy. However, if this works out, this will be just a trend that everyone wants to jump on, and it could be highly rewarding for VC. So it's definitely an eye opener. Let's hope for it to materialize soon.
Fahed, you read my mind with this, because this is actually my next question. This story totally reminds me of the early days of Silicon Valley. It's if you know the story of the Traitorous 8, the Fairchild, Intel, bold technical founders walking away from big corporations to build something on their own, something big and ambitious. In this case, the big corporation, in this case, MediaTek, they actually invested in them. So they're not Traitorous anymore. But it honestly, the kind of stories that created the VC industry in the 70s and 60s. I'm so excited to finally see this happening in the MENA region. And the question, as you mentioned, Fahed, why only 3 regional VC firms backed this round? Why not 10 or 15? I don't know. What needs to happen for more VC firms to invest in such companies in hardware, in deep tech hardware?
Yeah, no, I think simply we need to get smart. I think we've had an easy ride where we back marketplaces and SaaS companies and quick commerce companies and food tech and companies that are not rocket science in sectors that we can understand quickly. And we just need to get smart. I think there is a little bit of, and I'm going to speak for myself here, a little bit of laziness from the VC's point of view of being able to back things that they feel comfortable with, where it's an easy checkbox, especially when you see a strong founder. And there's been no real quote unquote incentive to go and do the extra work to back these sorts of companies. And I think now that we are seeing precedents happening and AI is really leveling the playing field across the board, we've seen a rise in the technical founders and companies that are going in the extra mile when it comes to complexity. And we just need to get smart and understand what they're doing and execute on that. And I also think it's a race. So whoever does it first, second, third is going to have a big advantage versus someone who's left behind. And I think we also need to do this with Nuwa. We're not exempt from this.
From my perspective, sitting in Palestine and the Levant, one, we need really strong R&D to happen in the universities. We need really strong professors. We need research. It just needs to be happening at a level that isn't happening yet. I don't know if it's happening so much more in Saudi and Qatar, but we're still not connecting that to capital. And that's the second part of my point, is that it requires very strong capital that most of us don't have, even some of the big funds. So it is a long time, right? And it requires IP, and protection of IP. So until, I think as a region, we start really addressing those things at a regional level, right? So for example, if you want to do anything in biotech or in real R&D for technology, you need to be able to to protect your IP across the board. You can't do that yet. You can do that maybe in some countries, but not across the board. And the waiting time, let me go back to the health tech example, right? Just to get clinical trials going and permits and permissions and all of that, it's just years and years and years that most of us just don't have. So it does require a different type of patient capital, heavy patient capital to come in, and strategic sort of thinking, I think at the government level, to just say, we're going to focus on this and we're going to connect all of the different players in order to do that. And so I think it will have to come from Saudi, from Qatar, from Kuwait, some of these countries that just have won the money and can attract the talent and expertise to those regions.
Let me answer your question in a different way. So let's state why we usually, or why do regional investors prefer to invest in software rather than hardware. So the key obvious advantages here is you need less time to go to market, as Ambar said. It's much more cheap to build a product and to start selling in a short period. And it's a global or a regional product since day one. You don't need facilities, you don't need manufacturing. And as Ambar also said, we don't have the time for that. So investing capital into software will get you returns much more in a faster way than hardware, because the whole cycle is much shorter. So that's the main reason why funds are focusing on software, apart from scalability, etc. So there's a huge gap in these elements when it comes to hardware manufacturing, regular brick and mortar businesses. And when you bridge that gaps, it's an eye opener. However, the biggest return here would be if you have the time and you have the capability to invest in hardware companies, is you get to see proper returns. That's why you see much more IRRs, returns on investment, etc., from hardware companies, but you have to wait 10, 15 years for it to materialize. So it's a matter of how much can you afford in terms of getting back your money, basically.
Yeah, but even then, Fahed, we're 10-year funds, right? We don't even have the structure to wait that long as a fund. I think one thing we could do to leapfrog is, again, going back to universities and supporting the commercialization of research that's happening at those universities. So let the universities take the time to really focus on the research and R&D, et cetera. Then the capital comes in to make it go to take it to market. You could start a bit smaller. It doesn't have to be as intensive as, sort of the IP that needs a lot of time for it to be allowed to be marketable. And then the other thing is corporates. We kind of started tracking corporates that might be doing the sort of R&D that might need this R&D to happen. So for example, in chip manufacturing, is it the NVIDIAs, is it the Intels, where you can attract them to Egypt and say, hey, we're starting to do this. Would you be interested? We have the people, we have the talent, Egypt is ready and supportive as a government. So can we do that as well?
Yeah, that's a good point, Ambar. It's the corporations. In this case, MediaTek was the corporation where those two worked, and then they found this opportunity, and MediaTek seeded the research and then seeded their startup to start this, and then they asked other VC firms to join. So maybe, we need more of these big corporations with big R&D that, hey, find something new in the market, a niche that it's too small for them to work on, but it's big enough for someone to quit their job from that corporation and focus on that small thing. That's a perfect case scenario for such an investment deal. Well, Jamie, take us back to quick commerce. What's happening in quick commerce this week?
Yeah, let's talk about rabbits. They've officially expanded into Saudi. Operations now have been live in Riyadh, I think actually quietly for a couple of months. They've now set up a regional HQ in the city as well. So I slightly cheated on this one because I actually interviewed Ahmad 2 days ago. So I've a bit of an insight, I suppose, beyond the press release, which is cool. So I guess in terms of the expansion itself, it's very much something that's been on the cards for a while. Like you mentioned in the original pitch deck, Saudi was in their crosshairs as early as kind of 2022. They raised that massive pre-seed in 21. At that time, I think it was the largest pre-seed that had been raised in the region up to that point. It's about $11 million or so. But I suppose they held off due to market conditions, and the last 3 years have really been spent building out the tech and the team and the operational muscle to sort of make this expansion tick. I think they're profitable now in Egypt, as I mentioned. They've been quietly testing in Riyadh the last couple of months. And then alongside this launch, they've also closed a new investment round. You've a stacked, list of investors there as well. Lorax Capital Partners, Global Ventures, Ride Ventures, Belt One. You've a load of existing adventures there too. Though the funding amount has remained disclosed, and I did ask him about this and whether there was a strategic point to this, and his response was, "We didn't want to make people feel bad." So take that.
Oh, wow. Okay.
Take that. Take that how you will. Look, Saudi's incredibly competitive at the moment, so I'm not overly surprised on one level. Maybe that doesn't want to disclose exactly how much the round was. Like you have a ton of players on the ground vying for market share. You have your Ninjas, who we covered a couple of weeks back, raising at the 1 billion valuation. Jahez are now getting in on the quick commerce side of things. Hunger Station are now. You have Nana.
And Talabat acquired one.
Yeah, look, you've Keisha now as well, the Myton's player, and they're going to be rolling out that, I'm going to mispronounce this, like Zhujiang, something to that effect. Their own dark store solution as well is in the pipeline. I know that was announced around the turn of the new year. But look, I asked him about this, how he feels about the competition side of things as well, and he said, look, he doesn't sort of perceive them as direct rivals. Like there's less than 6% of grocery shopping is done online in a Saudi context. So the real challenge on one level is the market education. And in his own words, he said, look, that the best experience wins. I also asked him about cash burn. Obviously, I suppose an industry or space notorious for it. We've seen our Getters and our Gorillas of the world soar and then sort of very, very quickly backtrack. And look, he kind of offered a pretty contrarian perspective on this. And he said, look, other players in the space, they've scaled fast and burnt heavily. They've kind of taken the opposite approach. They're focusing on unit economics, customer trust, etc. And they're playing the long game as opposed to the discount game. But look, that'll be difficult because there's a lot of discounting going on in quick commerce in Saudi at the moment. If you download Keisha, I know they're focused on food delivery at the moment, but my God, you are bombarded with discounts. There's discounts for everything. And even existing entrenched players like your Hunger Stations, Jahez, I mean, they've massively reduced their kind of like annual subscription price, like 2 to 3x to try and compete. So it's super competitive at the moment. So look, it's exciting. It's one to keep an eye on because there's a lot of players jockeying for position at the moment.
So Jamie, you mentioned that less than 6% of grocery is happening online in Saudi. I found another article that says It's actually 1.3% in Saudi compared to 5.3% in the UAE. This is definitely feels like the right moment for an aggressive push like this. But how many players can this market actually handle? Is it a winner takes all game, or are we more likely to see different startups dominate different cities across the country, given the country is so big? And given all that competition that Jamie was talking about, are they killing each other? Is it good for them? What do you think, Arnav?
Thank you for that. I mean, you've broke down all the players in the market. There's definitely a lot of them. And then you also touched on discounts. And I've seen myself when I go to Riyadh, like the amount of discounts you're receiving just for using Qteishat or any of these players, it's mind-boggling. It's great for the consumer, don't get me wrong, but it's mind-boggling. I'm a bit surprised that the numbers are so low, that you mentioned that the penetration of e-grocery is so low in Saudi today. There's a lot of players that are vying for market share, and some of them have been around for a long period of time. So my question is, well, if they've been around for a long period of time and it's only between 1% to 5%, why is that the case? Is it that people want to shop together? Is it that people physically want to go see their stores? Is there an education component needed? Those are all valid questions. I definitely do see that there's going to be a need of consolidation in the future. Many of the players that are in those regions are also public. So if you look at Jazz, for example, is a public company. A lot of the delivery hero players are public. Maybe because they're public, they can't subsidize as much as the newer players who are private, who are flush with cash, especially Ninja, that's doing super well. So I'm interested to see how it goes. I definitely do think there's going to need some consolidation to happen. I think food delivery and quick commerce are a little bit different. I mean, it's an amazing market for food delivery, but quick commerce has historically worked in places that are super, super dense. So if you look at India, for example, quick commerce is really, really doing well there because it's so dense. You can have these really small stores in just a building and service the whole building, and you can have a profitable dark store. Whereas in places like Riyadh, which is a little bit more sprawl and it's a much larger city, it's going to be harder to get through those quick deliveries and be profitable. So you're going to have to charge a lot more. I think we'll also see a lot of these players move towards private label. If I'm not mistaken, Rabbit in Egypt already does that in Egypt. I'm not sure if they're bringing that into Saudi, and you're seeing a lot of players globally go to private label to get that extra margin as well. So I think people are going to have to be a little bit, brainstorm a little bit on how to push their margins up. But I think it's going to be competitive. There's definitely going to be consolidation, and you'll definitely see some players win food delivery, some win quick commerce. It's not necessarily the same one that wins both, unless you're massively discounting. So I'm just curious to see how it goes, but definitely consolidation needed down the line. I think there'll be 3-4 players that win the market.
For me, there's not much to say. We did invest in one of the competitors that you mentioned. We had some insights about the market. It's definitely a big market, and I do believe the first movers towards certain geography usually have the biggest market share and can maintain it. However, it's expensive to maintain due to the high cost of returning users. So you find many of their expenses, these players are going towards the retaining users, acquiring new users. So it's a fierce competition. It's a fact, and has been there.
And the margins are very thin, right?
Absolutely. Margins are thin, and it's a logistical play as well. I think the market is big. However, it also allows for many players to keep on competing because there's no one player that wins all. It's just a matter of adapting and optimizing your cost and your strategy of how can you return and always acquire new users.
So I have a question here, Fahed, since you seem to know the market best. You know, is it when we talk about sort of this 1.3% of grocery bottom line, that's taking sort of an average of all of Saudi, right? But how is Riyadh compared to some of these smaller cities? And is it very much focused on Riyadh, Jeddah, and the bigger cities? And is there a need to spread this throughout Saudi, right? If I can't compare, but if I think of, again, Jordan, Palestine, and these small little villages, people don't really want their groceries delivered. They just want to be able to go to their corner store, get their shopping done, etc. Right? So is it similar? That's where I'm, sort of coming from. Where yes, it's a huge market, but does everybody really want it? Where are we talking about some major cities?
I mean, I think Arnav said something really important. It's a matter of education, constant education. So you can increase that penetration rate. But I think quick commerce in general, or delivery, or e-commerce has been growing rapidly in the Saudi market. However, this is a constant challenge because the legacy way of doing things is just going and picking up my own groceries, and it's still a favorable way in the market. I'm not sure about the rates that you mentioned. I think it could be
too
a bit
low. Yeah.
I think it could be a bit higher than that. I don't have the number right now.
I did push to
So
Ahmed as well in terms of, I guess, the city by city rollout. You know, I'd like to believe they're only live in Riyadh at the moment. And his answer was something like, "We've only been live for 60 days. I need to sleep a bit." So yeah, it's just Riyadh for now.
right.
But I did touch on as well, like obviously the diversity in terms of urban profiles throughout Saudi, and put them like obviously they're vastly diverse, and what works in Riyadh isn't necessarily going to work in your Jeddahs, etc. And look, he kind of really doubled down on, I guess, looking at expansion through kind of local knowledge. Like he was very much sort of reiterating the point that it's going to be Rabbit Saudi is going to be built by the Saudi team on the ground, and that he's not necessarily going to be making city by city decisions himself, and that he's going to be sort of empowering that team. So, you know, as someone who like he previously worked in Talabat Mart in Egypt, and I think he also worked with Uber as well. So he seems to be following that sort of Uber Careem kind of playbook in terms of, you know, allotting, you know, considerable amount of, I guess, power to the teams, regional teams, to sort of figure it out, and that they're best placed with their own local knowledge to figure out what makes most sense from expansion kind of perspective.
And Jamie, and maybe Fahed, because you've invested in this model, I wonder about the 20 minutes threshold that they set for themselves.
Yeah.
It's too tight. I lived in California. I used to order from Instacart and then from Amazon and from Whole Foods. It's all hours. No, nobody said 20 minutes. Like the minimum was like maybe 2 hours, and you pay extra to get that. But 20 minutes is too tight, right?
Imagine in Riyadh traffic.
Yeah.
Something.
Like usually I used to get my groceries after like afternoon, or maybe after 6 or 7 hours at night.
Yeah.
They would deliver, because I'll go with the default option, not to pay extra for the delivery. But if I pay extra, I would get it in 2 hours minimum.
I asked him about this, and like he's still very adamant that, you know, it's 1,200 seconds, and that they're going to be able to accomplish it. Like in terms of like from an ergonomics perspective, I was like, I'd love to see what those dark stars look like in order to be able to achieve that. But I do think they've adapted even the dark star layers to a Saudi context in terms of the amount of like entry points that they have within the store, and how they figured it out. But he did mention as well that that's something that would help in a Saudi context is sort of even the network sort of infrastructure in terms of the internet. He mentioned was even something that was more reliable in a Saudi context. So like he was saying that like it's a matter of seconds, like a 7 to 10 second outage, and he said most customers won't notice, but it's a big deal for them in terms of the delivery kind of disruption. So I think it takes 12 seconds from the moment an order is placed until someone starts picking it on average with Rabbit. And it takes about 150 seconds until the order then is packed and out the door. So you're looking at about 170 seconds from order to dispatch. So a 10-second delay somewhere along those lines obviously exerts a massive impact. So he said it was like a Formula One pit stop. So I'd love to see what that looks like.
I like that.
Also,
Yeah.
I'm curious to know how they manage their logistics. Do they do that through 3PLs versus having their own fleet? Because we've seen that make a difference in terms of distribution of drivers, when can you deliver, and what geographies can you cover immediately. So I think that's a pivotal point. Usually when players enter a market, they go through 3PLs, and then they start having their own fleets. And once they do that, that's a huge pivotal point on delivery time specifically and accuracy.
I'd also love to know whether they're setting up and leasing the dark stores themselves, or if they have like a real estate partner that's funding the capex. I think that'd be really interesting to know as well, if there's an appetite from Saudi investors to have like a real estate asset play, and they're just doing kind of the management of it.
Guys, you should have asked me these questions 2 days ago. I would have had the answers. This is, God, I missed an opportunity. I'm going to have to go back to Ahmad now and say, look, I have 2 follow-up questions
We
for
have
Fahed,
we have more questions.
Would you mind just letting me know before I publish the interview tomorrow what the story is? So, yeah.
Actually, you know what? And we will link the interview in the description of this video as well.
Good idea.
Yeah, God's sake.
Okay, Jamie, move us to the next story, last story for today.
Yeah, let's move across to the last story then. Another large funding round. So this time it's Pakistan's Haball. They are a supply chain financing platform. They've raised a 52 million in a pre-series A round. This is going to be utilized to expand into the GCC. Plans to enter Saudi in 2025, and future entries to the UAE and Qatar seem to be on the cards as well. Blend of equity and debt. Equity led by Zain VC, while the debt portion, which was I think $47 million of the total that came from Mizan Bank. So it's Pakistan's largest Islamic bank. And you had several Saudi-based investors also participated in the round too. In terms of what they do, it's focused on Sharia compliant SME financing. So they provide an end-to-end solution for payment collection, digital invoicing, tax compliance, working capital financing. And they already have a ton of big name clients as well. Like Coca-Cola, for instance, nearly 8,000 SMEs across Pakistan, processed over 3 billion in payments, dispersed 110 million in financing as well. So look, they've super strong traction at home. I suppose the big question is whether they can translate that kind of local playbook to regional scale, and how do they differentiate themselves in a competitive regulation heavy landscape like Saudi.
So Haball didn't go the invoice factoring route. They did the trade finance. That's a big difference here. In factoring, the seller gets the loan to get paid early on a discount. Then the lender collects the money after like 90 days or 60 days from the buyer. In trade finance, the buyer gets the loan to buy the goods and then pays back over time in installments. So Haball owns the full payment and financing pipelines between the sellers and buyers. And they decided to go with the second option, giving loans to the buyers. And here's my question. Which model do you think works better? Or maybe what verticals or sectors does one work better than the other? Have you seen great examples of either model being done really well?
I mean, I think both models work well in Saudi Arabia. I would start with that. I think both models solve bottlenecks of what's happening in Saudi, and the amount of funding that's being injected in this company shows how much potential this company could solve. I mean, there's a bottleneck currently in the market, and if you ask many companies, it's one of the biggest challenges, which is financing, digitizing receivables, payments, vendor credits. All these are challenges, and I think we've seen many players in this sector over the past couple of years enter the Saudi market and also being heavily funded, which shows how much the gap is in the market. So I think both directions work well and solve different aspects of this bottleneck.
I'm only asking because we're seeing many other players in the market doing the same thing, the second option. For example, because they're trying to expand to Saudi. It's a crowded arena in Saudi. We've already got Hala and Hala Finance, Lendo, Sella, even Brex solving the same problem for construction business. Generally, we're seeing SMEs, e-commerce companies, construction suppliers, all of these have service providers who solve their problems in there when it comes to trade finance or revenue-based financing or any of these, or SME financing in general. So how do you think Haball can stand out, especially coming from a different country, different culture, and trying to penetrate the Saudi market?
I think the big thing is the connection to the bank already, right? Is they already have somebody saying we're going to take the lending aspect here, which a lot of these other startups lack, right? You're raising money to provide the financing, and so they already have the financing partner. I'm curious to know what the target SME will be, because we started with Silk, where what is really important in a Silk type of example is that they have the data, right? They understand how much is being sold and when are they selling it, and when are payments due, et cetera, et cetera. So that data is super important to be able to make the decisions of financing at that level. If it's the type of SME, if we're talking bigger construction level companies, et cetera, then you have these large invoices, contracts, et cetera, which is much easier to finance, even at the bank level. So I think the space that the banks want is the tiny SME that needs financing, but it doesn't have these big contracts or the data to be able to provide to the bank and for the bank to make these decisions. And so that's where they would be solving for it. So that's where I would just like a bit more info here, but it just really depends who they're targeting. But I think the financing,
and they have that advantage, as you mentioned. Yeah, they have that connection with one of the biggest banks in Pakistan.
In Pakistan, yeah.
From my end, I'm just trying to wrap my head around it, to be honest with you guys, because there's so much happening with credit-led fintechs or lending fintechs, especially in Saudi Arabia. There's a lot of players. a lot of these players have also raised a large amount of debt over the last 6 to 9 months. I think we know personally of like 7 players who have gotten term sheets from JP Morgan, Goldman Sachs, and large facilities, $100 million plus facilities. Not all of them have closed, but at least received term sheets. So I think it really shows that this market is extremely debtable, right? You have a dollar-based currency. Defaults are systemically low just because of what happens if you default. And there's a lot of demand, especially with the world saying rates are going to go down. So people kind of want to push the capital that they have out the door. I think, Ambar, you made a really good point. I think if you take a step back and you say what differentiates each fintech, it's either your data or it's your balance sheet, right? So how much you can have and what's your cost of funding. If you come in with a bank, theoretically, you have the lowest cost of funding that's available into the market. The only thing I would say is that if I'm not mistaken, this is a Pakistani bank. So how much their cost of funding is in Pakistan compared to if you go to Saudi, you're going to lend in SAR, which is denominated in dollars. It's not really the same thing. It's very, very hard for a Pakistani bank or a Pakistani fintech to lend, let's say, in USD denominated currencies. And I would say we're seeing a lot more of these fintechs from Pakistan, from Egypt, come to Saudi to try and, because those markets are not doing super well on a macro perspective, and it's harder to lend. And a lot of the sources of borrowers is the government itself, especially in Pakistan. And you're getting almost a risk-free rate, so there's not that much incentive to lend for the private sector. So my only question is, are they doing this out of necessity? Are they doing this because they see it as a large market? What's the regulation, right? Is if the bank is regulated within Saudi, then they don't have to get regulated and go down that path. It's a big, big plus. I'm not sure if that bank is or not. I don't have that knowledge. But we're definitely seeing a lot of players in the financing space. And I think the theme of this episode was consolidation. I think at some point, you're going to see consolidation in the fintech space to combine the balance sheets and also the target segment of SME.
One thing I would like to add is from the 2 cases we looked at, expanding to Saudi Arabia, when it comes to lending specifically, is you don't need to be from the region to win the region, or you don't have to be from Saudi Arabia to win Saudi Arabia. You need just a product that solves pure enterprise pain, and there's a big room for many players, whether local or international, to enter the market. So it does make sense.
And we have examples of international companies trying to penetrate the MENA region, like Revolut. And I know Jamie is a big fan. I don't know, how are they doing in Dubai and Abu Dhabi now, Jamie?
It's a good question. They haven't gone live yet, to the best of my knowledge.
Okay.
So I'll follow up with you on that one. I'll look into that
Okay.
and I'll revert back. But thanks very much for the questions for Omar, Arnav, and Amber. That's great. It's much more helpful when I have the questions in advance of talking to him as opposed to afterwards. So thank you for doing my homework for me. This should be very straightforward, and I meet him next week.
That's awesome. And before we wrap up, a big thanks to OCTA for sponsoring today's episode.
Yes, if you want to get paid faster, access financing, and automate your receivable process, head to weareocta.com. That is weareocta.com, and take control of your accounts receivable today.
With that, thank you so much, Amber, Arnav, and Fahed for joining us. It's been a really fun episode. We hope to see you again soon.